Hi, Clark Harvey, the BBQ mortgage guy, owner of First Rate Mortgage. I've been serving clients for over 22 years in both residential and commercial lending in 5 states. Today, I want to talk to you about credit and credit scores and what's on your credit report and how that affects your credit scores. Well, there's a breakdown that they have certain percentages. Right here, 35% of your score is payment history. 30% are amounts owed versus credit available. And we're going to come back in detail on these. 15% is length of credit. 10% is new credit. 10% of your score is types of credit used. Okay, so this entails your credit score. So what I will say to people about credit scores is that you don't have a credit score until it's generated. Everyone likes to say my credit score is this, but the reality is that you don't have one until it's generated, until you actually pull credit, because it's specific to that day. Because on your credit, things are getting paid off, you're adding things on your credit, revolving credit, like a credit card. And so balances are changing all the time. So 2 days before, you might have a different score than 2 days after or a week. And so that affects your scores all the time. Well, let's talk about payment history. Well, clearly, the best way to keep a high credit score or high FICO is to pay your bills on time. Now, some of the things that do hurt your score are amounts owed versus credit available. For example, if you have a $10,000 credit line on a credit card, it's called a revolving credit line. And if you have, say, $8,000 on there, even though you've paid on time, it's going to adversely affect your scores. It's going to bring them down because what they're seeing is like, hey, this person is needing more credit. So I don't know if they're as strong a candidate for credit. Is there something happening behind the scenes? And they use what they call an algorithm that it's different for Experian, TransUnion, and Equifax. And it's even different from what we pull versus what you see, even though you may have a service provided by Equifax or TransUnion, something like that. That's outside of what we use. And that's a different algorithm. So you're always going to have a different score. Like if you're using a popular credit monitoring service, their scores are going to be different than what we pull, what we generate. What it is good for is watching to see what goes on your credit and what goes off and whether it's going up or down. That's what's important. It's always going to be different. Typically, you're going to see higher scores than what we actually pull. That's what I've seen year over year. Now, occasionally, ours are higher than the credit monitoring services. But just know it's going to be different. That's the point. And we have to use our credit report. So ideally, the amounts owed on a revolving credit line, now it's going to be different from what we call an installment loan. Like if you have a fixed auto loan or a fixed mortgage, that's called an installment loan. That's looked differently at versus a credit card, which is a revolving line, or even a HELOC, which is a revolving line. And so the optimal way to keep your score at the maximum score is keep only utilizing about 30% of that credit limit. So say, for example, a $10,000 line, don't put more than $3,000 on there. That's going to keep your scores optimized. Say if you have 2 credit cards and one's at $10,000, the other one's at $10,000, and you need to put $8,000 on a card, you're better off splitting that into 2 different cards that keep your scores, going. Length of credit is important too. So what I see all the time is people close out their credit cards. Well, and I get that for security and safety reasons to close them out, but it does affect, 15% of your score is length of credit. So ideally, if you can keep them open, that's the way to do it. Now, sometimes you don't use that card and you pay balance off. But if you put, say, a pack of gum on there once every 2 months, and just pay it off, then that's okay. That will keep that credit line open. Oftentimes in the contracts and the fine print, It says if you don't utilize this credit card every 6 months or at least once a year, then we're going to turn that off. We're going to close it down ourselves. And I know sometimes we all do, get into he said, she said on a credit, and you did this, you paid it, and so you get upset with them. You're like, fine, I'm going to close that out, and that's fine. Just know it's going to affect your credit. 10% of your score is new credit. Now, this is one of the favorite that people like to do, especially around the holidays, and a lot of retailers do that all day long. Hey, if you open up an account with us, you're going to save 10% on your purchase today. Especially around the holidays, it's a big time to do that. I recommend not doing that. I recommend, and certainly do whatever you like, is have just some of the major credit cards and just have that. You don't need every single store credit card. You have too many revolving lines of credit. It's hard to keep track of them. And that's where I see people get into, it's only just a little bit on here, but it adds up over time. But if you have, say, 3 major credit cards, whichever favorite one you like, then you can manage that better. You can see what's on there, and you don't need all these other open revolving credit lines. Now, 10% of types of credit used. We talked about installment, revolving. That's the main ones of credit used. So that when you pull your credit score, when it's generated, it looks and evaluates all these things. And so that's what generates your score. So if you're wanting to optimize your score and you're going to need to buy a car in the next few months or buy a house, look at your revolving credit cards and see where their balances are versus the limit. Now, I'm going to give you a little tip when it comes to revolving credit lines, that depending on how long you've used it, sometimes the way to optimize your score without paying the balance down is to call that credit card issuer and ask them for a line increase. They're going to pull your credit again to do that. Make sure you're paying your bills on time as well. And that's a way to do that without having to pay that balance down and to increase your score. Let's talk about kids credit. So how do you get your kids a credit score when they turn 18? Because most of us parents, we don't want to co-sign. We love our kids, but we really don't want to co-sign for automobiles or a house. And the way to do that is open up a checking account when they're young, 16 typically, an overdraft. You might have to co-sign on that, mom and dad, even if it's $100 or $200 overdraft. What that does is it starts credit with them right away. Another way to do it is you can certainly put them on one of your cards. You don't want to tell your kids because they might go and use it. But that's a way to start getting them credit history even by the time they're 18. And if you have at least 3 what we call trade lines or 3 different credit lines, then you're going to be helping them to establish their own credit themselves right away by the time they turn 18. So when they needing to buy a car, if they don't have the money to pay for it or buy a house, they'll actually have that all established, and they will thank you later, because that is a concern. Because when we go to pull credit, we look at that history. The lender, whoever you're going through, they're going to look at that history. They want to make sure that you're a good candidate to lend. And if you don't have any credit scores and any credit history, they don't know anything about you. Oftentimes we can still do loans with that. Just know that you're not going to get the best rate because you're a higher risk. And that's how they review everything when it comes to mortgage loans, that the risk, the lower the credit score, the greater the risk. So they're going to charge you a higher rate, just plain and simple. If they see that you're managing your credit well, then they're going to give you the better deal. Now, we know that life happens. things happen, divorce, death, people get sick. And so those things can be out of our control. But, managing it after the fact can help as well. The best thing you want to do after, if you do unfortunately have to go through a bankruptcy, is to then go out and reestablish some credit. And there's ways to do that, called like a secured credit card. You want to make sure that it reports to all three bureaus right away. And you can put, say, $500 on that secured line. You basically just deposit the $500 in the account, and you can go up to $500 and using a credit card. Well, that's a way to reestablish yourself. It's very important to do that. And then you'll see over time, as you do more of that, you'll see that you can get away from that and then actually get other credit offers and use that. And thus you've since rebuilt and rebuilding your credit. And that's very important to do. I hope this has been helpful. If you have more questions about credit and credit scores, we're here and available to help. You can reach out at 801-562-9100. Thanks, and have a great day. Have a great day. I can be reached at thebbqmortgageguy.com. Please subscribe and like to our channel. You guys have a blessed day.
You've been listening to Clark Harvey, the BBQ Mortgage Guy. Clark is a licensed mortgage loan originator, NMLS number 240452, and his company, First Rate Mortgage, NMLS number 1172332. You can get a hold of Clark at area code 801-562-9100 or at his website at www.thebbqmortgageguy.com.